Our next session, Real Estate, the Best Asset Class for Returns, will be moderated by Mr. Sameer Nayar, Executive Vice President, Strategic Development, the Oberoi Group. He is responsible for global strategy and hotel development function, overseeing the company's expansion in domestic and international markets. Mr. Nayar is joined on stage by Mr. Michael Holland, Chief Executive Officer, Embassy Office Park REIT, Ms. Nirupa Shankar, Executive Director, Brigade Group, and Mr. Snehdeep Aggarwal, Founder Chairman, Bhartiya Group.
You come in the middle.
Come. Thanks. Yeah. Maybe you come here.
Right. Yeah. This is the grave.
Good evening. Am I audible? Good evening, ladies and gentlemen. Very excited to be here at this session to talk about real estate as the asset class. And we've got a preeminent panel here, different developers, incidentally from Bangalore, but who have participated in and been in different real estate classes. I'd like them to introduce.
Thanks, Samir. Good evening, everyone. I'm Nirupa Shankar. I'm a director at Brigade Group. Brigade is a 35-year-old real estate development company with headquarters in Bangalore. We started off as a commercial developer, actually, but today our portfolio is mostly residential, and we also have assets in office, retail, hospitality, about 8 hotels currently, and 2 more under construction that were paused due to COVID. Yeah, so that's it.
Mr. Snehdeep Aggarwal of Bhartiya City.
Hello. Yeah, this works, yeah. So I'm Snehdeep Aggarwal. I work for the Bhartiya Group. We got into development very recently in the last, about 8 years ago. And in the last 8 years, we're trying to build a new city within the city of Bangalore, which will eventually a city for about 200,000 people to live, work, and pass through the city every day. With the promise that you can walk and cycle in my country with pride and dignity. So that's the promise for the city. Yeah.
Mr. Michael Holland.
Sure. And I think Mr. Aggarwal's city is already delivering on that promise, right? It's a very nice development in Bangalore. And it is interesting that all 3 of us are based in Bangalore, or our main schemes are. Yeah, so I'm Mike Holland. I look after the Embassy REIT, which is a listed entity. It's pretty much exactly 3 years since we listed. We're primarily a commercial owner and asset manager. So under the REIT regulations, not more than 20% of our portfolio can be under development. So 80% needs to be completed and income producing. So we're more of an asset owner and manager rather than a developer. And as I say, it's primarily an office portfolio. Just about 5% of our GAV is hotels. And we primarily have those hotels as part of the overall offering to our commercial tenants on our business parks.
Wonderful.
Thanks.
So let me start with you, Nirupa. 47 million square feet in resi, 20 million in commercial, more than 20 million, and only 8 hotels. What's going on?
8 hotels, they are low on square footage, but they have their bang for their buck, you know. So I think everybody knows, right, the case with hotels, it's high capex and a slow gestation period or very long gestation period. So you have to be very careful about where you make your investment, how much you sort of allocate. As a company, I think, you know, we like to have most 70% of our business is residential, and that's your cyclical income, and but it's also your faster and higher ROIs. However, the balance 30% is sort of allocated to high capex projects like office, retail, hotels, and like I said, with hotels, they are a tough asset. I would say across all asset classes within real estate, hotels are probably the most complex form of real estate and probably the one with highest volatility. So you do have to be careful how you allocate and how much you allocate towards that business, because it is the most complex in terms of development and operations.
But I would have thought that, residential gives you a cushion. It's instant monetization. Your commercial is a stable cash flow. And potentially, you could have, or the group could have looked at expanding more the hotel footprint. I mean, do you see that happening, changing in the future, considering where India is today, where the hotel supply is only, it's short. It needs many more hotels for the growth to sustain. Do you feel that will change for you?
Yeah, I think the decision to develop more hotels is purely based on the kind of land that we acquire, right? So every parcel of land, first of all, it's hard to get a clean parcel of land with clean titles at the right price, and hotels are very much dependent on what is the land price that you pay for it in order to make the feasibility work. So once you buy a parcel of land, it's very important to see what is the highest and best use for that parcel of land. So if it makes sense to do resi, we do resi. If it makes sense to do office, we do office. If it makes sense to do hotels, only then if highest and best use of, say, a nice 1 acre parcel of land in the middle of the city makes sense for a hotel, then we'll do a hotel. But also as a company, we love the concept of mixed use developments. We were the founders of mixed use developments in southern India. This whole concept of live, work, play is the future of all cities and metro cities in the country, because with the kind of pressures on infrastructure, the only way to grow or to sort of develop in a sustainable manner is when you have your cities within cities.
Talking about cities, Mr. Aggarwal, I'll move to you, where you are actually creating a city. You have started. It's a huge 150-acre parcel of land that I've had the privilege of being through with you and walking the site and seeing everything, and it's fabulous. Right? I mean, the whole commercial idea, the Nico homes, the Leela residences, the hotel that's there, and the future hotel. Talk to us a little bit about how you think of phasing and your capital allocation when you're conceiving something like a city, right? I mean, it's not just distinct asset classes, but they all need to gel together. How do you think of capital allocation?
Yeah, so Mike, your partner met me 4 or 5 years ago. So I used to meet you 10 years ago, 12 years ago, 13 years ago.
Yep.
So he said, Mr. Aggarwal, we thought you were a madman then. So I used to talk about city. Without that time, you don't think of capital allocation, right? You just dream and you say, I will do this city. We had no choice but to get into every vertical of real estate because of Bhartiya city. And hotel is incidental. We said it's a city center, and the city center, we said, must have a convention space. Bangalore needs good convention space. And if you do convention, then you must have hotels. So we said we'll do 3 hotels, because once you do a convention where you can get 5,000 people, then you need rooms for them. And we are developing this as a city center. So when you do city center, I thought people go and live in city centers, so hotels are not destination. We have a lot of IT space there. Eventually we'll have over maybe 100,000 people or 150,000 people working in those IT offices. So hospitality and hotels will be important, so people can stay there. So our entry into hotels is incidental, and now we have to think, as we go forward, we'll think where to allocate capital. That's a question my son can answer better than me.
No, it's good to hear that. It's very good to hear that. I mean, you're talking of city, if you've developed a school,
yeah.
you've developed a training facility, you've developed a number of different verticals, like you're saying. And do you believe that maybe 5 years hence, 10 years hence, that mix is likely to change, that you may see more the need for entertainment, or sort of how do you think you're a very design-oriented person in terms of getting communities together or getting the whole the precinct to work together? How do you think of that?
Yeah, how the precincts work together, actually, it is in the first thought. We divided this city into 8 precincts. The biggest challenge for us in the beginning, in the master planning, was how does it look like a development site for the next 20 years that we're developing. So we divided it into 8 precincts, and we thought each precinct is separate by its own, and the common infrastructure should be developed first, so that as you enter with the first precinct, which was Niku Homes, as precinct 1, it should already look like a working city. Yeah? So it's initially, if you not design it well, it doesn't work. And I remember we had the initial master planner, and we spent 9 months doing the first master planning. And then an architecture firm from Australia, that Richard Philip Cox, he came to see me, and I showed him the master plan, very proud. And looking at it, he said, this will not work. So we had got a person from Hindustan Lever, Peter Selvaraj, and he said, we've spent so much money, 9 months, and he said, it doesn't work. So he said, tell us, just give me $50,000 and 3 months, and I'll tell you why it'll not work. And the local architect, he said he's taking you for a walk. Sab theek hai. But I think it was the best $50,000 that we spent. And those 3 months gave us time to think how this will work together. I think it is in the design thinking in the beginning, not just in the physical design, how these cities should interact with each other, how the commercial and the retail and the housing, they all must complement each other. So it's very tough. It seems simple, but a lot of thought must go into this. And I think that initial time we spent was well spent.
Yeah, absolutely.
Michael, I'll come to you. Again, you very elegantly mentioned about the REIT and the remit of the REIT, and it's predominantly commercial oriented, and you look at hotels very much an amenity that is supportive. Do you see going forward adding more hotels, maybe on a little bit more independent basis, to the REIT within the limits, within permission?
I think at the moment the answer to that is a clear no, other than within our existing large-scale business parks. So, or within the overall arena around some of our business parks where we don't have a hotel. So it's all, there's a couple of things I want to kind of link it to that Mr. Aggarwal is saying. This whole idea of scale is really important nowadays in the type of product that we're all producing. That it's not really, it's very unusual, I think, that one is looking at a one-off standalone building, whatever that is, office, hotel, retail. What we're seeing, and we've seen evolve over the last decade, is this large-scale, planned, mini township type of, it's about the product offering. So that's not a market that can be accessed by every developer because it requires a long gestation period, to take Nirupa's term. So at least a decade to produce these types of product. So you have to have the capital ability to sustain that. You have to have the vision to be able to deal with the naysayers. And you have to pull on expertise from multiple different uses. So that's why I often say to our international investors that we've seen a concentration into fewer, larger, more institutional developers and asset owners in India. And I think that trend will continue. And then within that product mix, you will see, and we would certainly look at every one of our large-scale products as to whether or not it could take. So this, to go back to your capital allocation, it's not about saying I'm going to allocate X percentage of capital to a particular type of use. You have to start, I guess, with who's your customer in mind and what product mix is optimal for that customer. So, and that's how you end up with a master planned project that works. And if that includes a requirement for meetings, conferencing, hotels, then you have to unpack that further. And I think we've all got a lot more sophisticated about deciding on where are you positioning that hotel, how big should that conferencing be. And we've just opened, and we're opening a Hilton and a Hilton Garden Inn, totaling 600 rooms in Manyata on the north side of Bangalore. 3-4 years ago, I was really concerned that that was going to be way too big for the market. And I think actually it's turning out to be, and our hotel expert within our team was constantly telling us, no, this is the right size, we can cope with this, and there's a demand for conferencing. But we also went to many of our top corporate office occupiers and spoke to their travel and procurement people and figured out where did they want the positioning. Because often, I think in developing markets, we have ended up with an operator that may or may not be well suited to the customer base. It might be too high up the chain. So I think we'll look at hotels in the context of our existing assets or assets that we acquire, and do our customers, which for us is largely corporate office occupiers, what do they want? And then we'll pursue our strategy based on what they want.
So talking of your investors for a moment, I remember one of our earlier conversations, you referred stable cash flows, easy to finance.
Yeah.
You got the right institution and the long patient money backing it, which obviously the hotel, which is a daily price business and a decent amount of operating risk, doesn't permit. Do you believe, most of your hotel, all of them are on a management contract. Do you believe there's any modification in such terms with the hotel operators that may excite you more to do, so that that level of, there's an element of de-risking that happens, right? Do you think that might bring about a change in the way the planning is done today, whether it's through guarantees or certain amount of short leases or so?
I would again go back to why I wouldn't even say we are in the hotel business. Why do we own 4 hotels? It's because our corporate office occupiers benefit from that, and that gives us a competitive advantage in that corporate office leasing space, right? That product mix. You can tweak the details of what's our operating contracts and so on. We deliberately selected and maintained a relationship with a global operator precisely so that they bring their expertise to the table, and we, who are not experts in hotels, are not managing the day-to-day or quarter-to-quarter elements of a hotel. We do have a team within our management, but just 3 people who are responsible from the owner side. So we'll always be looking at, can we do it better? But fundamentally, for us, the benefit is simply having it in our product mix.
Got it. Mr. Aggarwal, for yourself, as you where the current phase of Bhartiya City is, but if I were to look at and start talking about different asset classes and whether that could come into play at Bhartiya City or beyond, let's talk of leisure for a moment. Entirely different from Bhartiya City, but is that a space you feel you could be active in?
I don't know about us, that's a thing that we still think, but I think leisure is going to boom, really boom in this country. And there is so much opportunity. But it's again, whether supply comes first or demand comes first, supply and demand. But there is inherent demand, and in the next 10 years, 20 years, you see the rates for the leisure properties going up. I'm just told that they opened a new Marriott on the outskirts of Bangalore. And I was very envious because they're selling a room for 26,000 rupees there. My guys were offering a room for 9,000 or 8,000.
Yeah.
Right, so that shows how much opportunity in the leisure, because there is nothing good. And I think we need to get innovative as a country. One point I want to make, that in India, you don't have to just follow the Western brands, right? We still have a lot of development to do in our resort or leisure spaces. So that must happen simultaneously as you develop these resort hotels or leisure hotels. It has to coexist. But so looking at from that point of view, we are 1.3 billion people, right? And how many of us travel? But immediately you'll see in the next 4, 5, 6, 7 years, you will have no space for people to go. People are wanting to get out of their urban cities where they stay. Huge opportunity, huge opportunity. I think the industry, there must be more interaction and thought in how Indian industry or Indian developers or Indian leisure industry must develop.
Yeah.
Yeah. So if you see Europe, if you go, if you drive, if you go to the Alps, you have lot of family-owned smaller leisure hotels or resorts, which are extraordinary. And I've traveled to Italy now last 40 years. We have a company there last 25 years. And if you go and see these small places in the resorts or leisure space, some of them are extraordinary. In Tuscany, you have thousands of them. I think India has an opportunity to look at leisure from that perspective. Yeah.
Nirupa, to you, how would you evaluate investment in a leisure asset? I mean, it's a very different asset class. Presumably, none of your hotels they're all in the city centers. They're all speaking to the same language of supporting a corporate customer and managed by some of the international brands. But if you were to look at leisure or different asset classes, feel free to talk about co-living, student housing. I mean, these are all very active. They've had their phase of funding. Do you see Brigade going more into these areas?
Yeah, so I think when you look at real estate, right, I would say resi is the least risky, followed by office, followed by retail, and then hospitality. So making hospitality the riskiest asset amongst all real estate assets. And prior to COVID, in the hotel business, I would say leisure was more risky than business hotels prior to COVID, right? So leisure had another element of risk associated with it because it was more weekend business, so the occupancies were typically lower than business hotels. So suppose an average business hotel was at 75%, leisure was probably at 65, 60%. So there was a little more element of risk with leisure. Obviously, during COVID and post-COVID, leisure has been one of the winners, and the rates are definitely make business hotel owners jealous. I definitely wish we had more leisure destinations today. It's something I think we would evaluate today because of the kind of rates that you're seeing, but also a hotel is not something you build for a trend. It's something you build for the next 40 years or 50 years or even 100 years. So that said, I think leisure is here to stay. There will be, people do want experiences, people do want to travel, they do understand that they're willing to pay the premium right now. So leisure is something we would definitely look at. We moved into co-working spaces, if you're talking about co-living and student housing and all that. Typically, as a developer, you want to stay away from a lot of heavy operational businesses. You want to build and then give it to an established operator. But I don't think there is a very well-organized co-living player at the moment. So we've spoken to a dozen of them, and it's opportunistic at the moment. But I think the co-living is very much, I think, like the service department business, but at a lower level, a couple of notches lower. Again, I would love to see stronger co-working players. I don't want to get into the business myself at the moment. But if there was a strong co-living player, we would definitely be interested to talk to them.
Yeah, I mean, as an example, Stanza Living comes to mind. They've been very active, I think more than 45,000 rooms now, and somewhere I read about delivering 1 million meals a day because they've set up the cloud kitchen supporting this. I mean, I'm just talking about how they've diversified into different businesses, and the cloud kitchen is supporting not just their own units, but even beyond, and they're setting up the delivery networks. I mean, it's interesting. Some of these plays. And even on leisure, I mean, a combination of, the good old timeshare model and all have helped developers diversify. I mean, the question really is, will the trend of ownership of second homes go away and people invest more through these membership schemes, which is always going to be beneficial for developers? What's your take on that? Would that come along? Would that
See,
help you in
again,
any manner?
the moment you have co-living, it again has a bit of a hospitality play to it. So again, I mean, honestly, as a developer, as a primary residential developer, you want to just build and sell. That's your quickest ROI. So you have to sort of figure out which asset is your long-term play and which you're willing to wait for 7 to 8 years to get your returns, and which you just want it in 2 to 3 years. So for Resi, I think our preference is just build, sell. If it's a hospitality play, then you might look at service department or hotels, or maybe, and to me, co-living has a very strong hospitality play.
Got it. Michael, let me ask you, you've been on the Embassy REIT, and when do you think, if you were to have a crystal ball and gaze into it, India would be ready for a hotel REIT? We're nowhere near that. It's still, with at least groups like ours, traditionally own and build model still. Of course, there is a huge amount of management contracts happening. But what would it take for India to get to a hotel REIT model? It's fairly active in the Asian market. It's fairly active in the North America market. So happy to hear your thoughts on that.
Yeah, I don't think that it's necessarily more than a couple, 2, 3 years away, necessarily. Clearly, what is required is that, A, the performance of the hotels reaches a point that there's predictability in it, so some level of stabilization post-COVID. And then the other issue that needs to come together is an acceptance or a realization of the risk-reward, and therefore the pricing that is applied to the hotel as it gets sold into a REIT. And historically, hotels have been very richly priced when you compare against some other asset classes. So there's no reason why there shouldn't be a REIT that was primarily a hotel REIT, but those things need to happen. The industry or the demand side businesses need to stabilize, and pricing, people need to get comfortable with what are the areas of risk of operations. I mean, we've just lived through 2 years that have completely changed the way in which hotels have been operating here. And that's an illustration of how the pricing needs to reflect those types of events. A great mentor of mine years ago, hotel specialist Peter Barge, used to say, in a hotel business, you're starting from zero every day.
Every day.
And in other sectors, residential, office, you've got long-term, good quality covenant contracts in office. In residential, you've got liquidity and you've got leverage. So the pricing side of what's the hotel worth, that's where I think that will hold up institutionalization of hotels.
Yeah, I mean, and as operators, we know that getting the rate is the key to it. because that's where the buffer comes in to de-risk. And in India, with the start-stop of supply, and over the years, getting that rate hike has been difficult. I mean, even we operate at the premium end of the segment, and we've managed it, but that is something I think which will help us go a long way. Do you see more funds getting, or just your thoughts around, because you've been active in the REIT market and the institutional market, do you see institutions getting more excited about hotel ownership in India? I mean, there are a handful of institutional owners today. It's mostly with the family offices or small developer communities. What do you think one can do to...
I think what you're seeing across all sectors is more institutional money, generally international money, whether it be private or public, in established real estate sectors. So sovereign funds, we know who they are here and looking at multiple different sectors. Some of the large private equity players are bringing institutional capital into hotel sector, into logistics, industrial. So that type of money coming in there's two things that I'd say are relevant. One, it's there aplenty, so there's plenty of capital, as Nirupa was saying just before we sat down. There's plenty of capital, and it's rational capital. So, it has the ability to see through the ups and downs and the peaks and troughs. So I think that, for example, if you talk about the hotel sector, there is a greater ability to hold through the difficult times and maybe to support the rates as opposed to more traditional capital, which is constrained, and then there's a price war, and that just drags down the value of the asset. So I think more institutional capital allows people to take a longer-term view, a more rational view, looking at long-term asset values. And again, I think that's a good thing for those types of players, and it'll be a good thing for the hotel sector.
Mr. Aggarwal, do you see yourself as long-term hotel investor, owner, or do you believe there could be a time when you could be exiting some of your developments, hotel assets? And I'm being very selfishly looking at hotels for a reason.
There is an exit in everything in life, right? There should be an exit in everything. But at this stage is the wrong time to ask me that question. We just opened the first hotel. We are having fun.
Certainly.
We are having fun. It's beautiful. Everybody's complimenting me. Yeah, if it does well, and we'll make sure it does well.
So you are a long-term investor.
Yeah, sure.
You're willing to sit out.
Yes, yes.
Nirupa, yourself?
Yes, there's an exit at the right value always. I agree. I think it's important for assets to be monetized, right? I mean, everybody looks for monetization. Once you're public, everything is about monetization, unlocking the value. And unfortunately or fortunately with hotels, you see the true value only once you exit from that property, because hotels are always valued on their cash flows, and sometimes those returns are in single digits, more often than not. But at least when you exit, you're looking at a double-digit return. So the true value of a hotel is seen once you exit. So the timing for that exit is crucial. We definitely do hope to unlock some value from the hotel portfolio, because I think that'll do the shareholders good. But yeah, it's all at the right time, at the right value.
Wonderful.
Can I just comment on that? So, years ago when I worked in London, people used to contrast trader developers and investor developers, right? And actually, if one is able to apply one's capital, particularly at the land level, and get through the development cycle in a reasonable period of time, and then trade out and reapply that capital in the same way, while the risks are clearly more challenging and it requires a particular level of expertise, then selling out of a hotel for a trader developer is probably the right thing to do because they can reapply that capital and go again. For the asset-owning developer, it is more about maintaining that asset and that stable income, and there'll be a lower return on that capital. So it just depends on what the business model and the strategy of the entity is.
I was just, meeting the Radisson global head of development just now. Jadip took me to meet him. And he said the hotel business is father-son business. Mr. Aggarwal, if fathers build and sons hold it and the grandchildren hold it, he just said that. I said, okay. So
one way to look at capital allocation. Brilliant. I think we've got about 11 minutes left and there are a few questions. Let's see if we can put them up here. Or let me read out from here if I could. Embassy REIT, what's your approach in choosing the right asset and class, office park or, right asset class, office park or hotel?
Yeah.
Would there be any mid-scale hotels in your portfolio?
Yeah. I mean, I think that's for me anyway, it's a very interesting question. I hope it is for everyone else. But it goes back to the comment I made earlier on that when we were looking at a new set of hotels, we asked our core customer. And our core customer are largely international technology-related corporations that sit in our business parks. So what is their type of spend? What do they need and use hotels for? And we did that in a quantitative way. And we came up with the fact that we needed something that was more mid-scale and something that was a little bit higher end from a business perspective. And that's how we ended up with a Hilton Garden Inn. And next month we'll be opening a Hilton, both on Manyata, for precisely that reason, that you're trying to target. And together, that's over 600 rooms. But actually, we feel that that's going to do very well. It's already doing well after just 1 month. So I think you have to go back to who's your consumer base. Who's going to take the rooms? Is it leisure? Is it business? Are you doing conferencing? Are you doing some sort of weekend personal trade, weddings and all of that? If you can mix that together, then that's the perfect combination. But I don't think we would have a cookie cutter approach for different locations. We'd look at each location and figure out what do our stakeholder customers want.
I think even the second question slightly pointed to you, Mike, which is correlation between office space occupancy rate and hotel occupancy rate in business location in the city centers. I mean, your office occupancies are a little longer tie-ins compared to hotel, which is daily occupancy, but happy to hear your thoughts.
Yeah, for sure. Maybe not directly on occupancy rates, because as you imply, that is a very long-term and slow-changing number, because people are on 5-year contracts. But, of course, the more business activity there is, the more hiring that's going on, or the more leasing, for example, that we would do this quarter, I think you can say there's a strong correlation with what's happening in the business hotel side. Maybe not the leisure side, but, and I have to say that it feels really positive, particularly in the last month, the way in which businesses, again, particularly Bangalore-centric, are hiring at phenomenal rates. And we therefore feel that by the end of this calendar year, we're going to see strong leasing, and I think we're already seeing a strong uptick in the hotel side. Is that what you're seeing, Nirupa?
Yeah, absolutely. I think office occupiers have already started coming into the market. I mean, back into the office space. In some of our, our office parks, the occupancy has gone up to almost 25-35%. So definitely, month on month, there's going to be an increase in office occupiers. The interesting thing with that, the question was that, I noticed in one of our hotels that the client or the company that was giving us the highest number of rooms was also paying the highest rate. So I asked my team, I said, there looks like something wrong with this because usually there's economies of scale. And the more number of rooms you give a hotel, typically the better rate they should get. But here, the client that was giving us the highest number of rooms was also paying the highest rate. And I asked my team, how come you managed to get that? And basically they said because the office was right next to the hotel, they were almost paying like a convenience premium. You know, so definitely the occupancies of the office impact the rates in the hotels too.
Yeah.
Mr. Aggarwal, I think the next one's for you. What's the risk in a hotel and a branded residential, since that's something you're implementing at Bhartiya City? Just talk to us a little bit about having a luxury hotel and residences which are sold and then managed by the hotel. How does that factor in your thinking?
Well, I think this offering that we have brought, that you live in your own residence, in your own home, and it's managed by a five-star hotel, or for that matter, any branded hotel group, I think there's a great opportunity. If you look at the RWAs, the so-called Resident Welfare Associations, they don't know anything about managing residential estates. I have to say that when you build residential, then these RWAs come in and they start to downgrade. And that's my first dream was shattered, when I brought in the RWA, because I was dreaming and my son was telling me every time you're mad and you're doing this. And I said, no. And then the RWA comes, and they want to. So I think there is a great opportunity for managing residential estates. And I think hotels should get into managing large-scale residential estates. They should do that. Ultimately, all that the industry has learned about giving good quality of life, all over people, I know American stars who always made hotel as their residence. They enjoyed living in that hotel so much. It was more comfortable and better for their life. So I think this managing residential spaces is part of the hospitality culture, a huge potential. We are looking forward to delivering all these residences, and we suddenly see as the hotel became live, we had 25, 30 units left, and suddenly there is a scramble to buy them.
I mean, it's a good space you touch upon this. We as a group, we are doing residences for sale on a standalone basis, branded, and we're managing it. I think the limitation comes down to the common area charge, right? I mean, people may spend several crores in buying the property, but the common area charge is generally pegged to what's going on in the market. Now, if the moment you try and elevate the amenities and the service and the staff, that becomes a limitation. And it's a strong limitation because the developers often ask the question, that's fine, but what is the common area charge? Like the good old Maruti joke, gaadi achhi hai, but deti kitna? It's the same thing. People are very focused on that monthly outflow.
It will balance out, don't worry.
It will balance.
As scale happens, you guys will lower your rates.
No, we figured it out. We're doing it.
On the bigger scale, I think it will happen.
Brilliant, brilliant. I think we may have time for one more question. Let me pick the second one. Are vacation rentals going to gain traction in India? I think we touched on it a little bit earlier. How are homestays affecting the developer ecosystem? Same thing about the leisure properties and any new thoughts, anyone, on whether rental business is going to be a big play where you develop properties, offer them for rent, and new developers or a brand is managing them. Nirupa, maybe you could.
I'm not a huge fan of the homestay business. Like I said, if you want to do a hotel, I would prefer having at least 125 keys just because it gives you those economies to scale. Because honestly, the kind of effort that goes into either a 10-room property or a 50-room property is kind of the same. You have the same heartache and the same pain as a 400-room hotel. So I'd rather just go with the scale because at least the returns are healthy. Right. There are hotels that can give you, say, 5 crores in GOP, and there are hotels that can give you 50 or 100 crores in GOP. I'd rather go with the big boxes. Yeah. So not a fan of the homestay business.
Got it. There's a question about Embassy and Brigade, will you be looking at investments outside Bangalore, South India? I know, I mean, Embassy is there in NCR, but Mike, maybe perhaps you could...
Yeah, we are indeed looking at potential acquisitions outside Bangalore. We're currently in Pune. I think at the moment we're looking really at the top 6 metros. Similar business model, similar target consumer base, which are these large-scale technology-related companies. Yeah, we may look beyond those 6 metros, but that's broadly it. It's an interesting question, so thank you, whoever put that out there about internationally. At the moment, the answer to that is no, we're not, but it's very interesting to see many, particularly Singaporean REITs, and maybe 1 or 2 Australians, are acquiring different sectors, such as industrial. So you've got ascenders of mixed industrial and office here in India, but you've got those Singaporean REITs who are acquiring quite significantly in Europe. So I think that's a trend that we will see at some point, but we're not looking at it at the moment. You know, not forgetting that it's only 3 years since the first REIT listing. So it's we're just now, I think, really getting the market is understanding the REIT, the regulations, the appeal, you know, the difference between a REIT and a traditional developer. So I think it'll take some time before we go to that route. Sorry, Nirupa.
Got it.
Thank you. The question was also for Nirupa.
It's okay. You answered it, so it's fine.
Wonderful. I think we are nearly out of time, and I think it was a very heartening session. Very happy to hear your thoughts on, you know, hopefully we'll get takeaways on how we can get more capital into this industry, into our sector. Hopefully some of those thoughts that you had, we can help you change. Your point about the asset prices and going into the REIT is a valid one. Like somebody mentioned yesterday, there are distressed assets, but you'll never find one. There's distress in the market, but you'll never find one.
Right.
They just don't transact. Right. And I think that's a systemic problem. So hopefully it'll change.
Yeah.
Thank you.
Thank you. Thank you very much.
Thank you very much.